Hey guys, Youngit here. So today I'm going to share with you guys this video on one of the top misconception people have in the market regarding the stock price, how to determine whether if this stock is expensive or not. Right? So one of the most common misconceptions is that people take a look at these two examples, right? We have Ford Motor here on the left and we have Tesla here on the right. Now we see that Ford Motor here is $9.83 and Tesla is at $190.63. Now let's not take into account what happened in the market the past few days. Let's just focus on the price of the stock. Now when we take a look at the price of a stock, which do you think is more expensive? Ford Motors or Tesla? Now, to a very inexperienced investor or someone who's new into investing, they will straight assume that, hey, Tesla is so much more expensive or Ford Motor is so much cheaper, right? So this is how they'll actually classify it, because they look at the share price to justify whether it's expensive or not. But this is the wrong way to justify. Why? Let's take a quick look. So when we scroll down here, we can see that Ford Motor, although it's trading at $9.83, it has a market cap, means the whole overall company is worth $39 billion, as compared to Tesla, which is like $190, but the whole overall market cap is just $33 billion. It is $6 billion smaller than Ford Motors. Now, there is no right or wrong whether the company's share price is expensive or not, but I'm just saying that it can be manipulated by the number of share floats in the market. So for example, like a company A decided has a market cap of $100, they distribute 10 shares out to the market, right? So overall per share is like $10, right? Or as compared to another company that is like maybe similarly $100, they distribute just one share. Alright, the market price of the company will be $100. So it can be manipulated and it should not be used to determine whether a stock is expensive or not. Now, what should be used to determine whether a stock is expensive or not is through the price to earnings ratio, which is this one over here, the PE ratio. The PE ratio in simple form is just basically how many years it is required for you to earn back the money you invested. So in Ford Motors case, you have to take around 12.7 years, which is around 13 years lah. Whereas you look at Tesla, right, on the other hand, you can see that Tesla is a dash here. Why? Because Tesla is still not making money. It's still currently unprofitable, and that's why the amount of years to return the money back to you is still undetermined. Now, how can you understand all these things? Now, basically the formulas goes as by price over earnings per share equals to your PE ratio. Now, where can you find the price? The price is basically over here. Where can you find the earnings per share? Now, earnings per share, you can simply go to morningstar.com. You can see that over here, earnings per share for Ford Motor is right over here, earnings per share. So basically, you want to take the last year, so which is $9.83 divided by 92 cents. Or if you want to use the TTM 12 month trading average, you can use the 0.78. Alright, likewise for Tesla, you can also go the same thing. Go over here and find their earnings per share. Now this will actually give you a better gauge whether the company is performing, whether the company is able to generate you money, and how long would they need to actually pay you back the money, not really pay, but like return you back the money that you actually invested in them. Alright, so once again, just a quick summary is that please don't look at the price to determine whether the company is expensive or not. Please look at the valuation of the company to determine whether it's expensive or cheap. Alright, so this is the end of today's sharing session. I hope you actually gotten something of value from this video, and I hope to see you next time again. Bye bye.